everyone, Joe Mass here. Hey, it's Friday afternoon. I just wanted to give you a quick shout out before the weekend. Hey, over the last couple of weeks, we've been doing some rebalancing of the portfolios, and wow, it's been crazy this time. We rebalance about 4 times a year, and on Thursday morning before we were getting ready to trade, the markets had changed, and I changed my mind. We reshifted, we put things on hold, and so it's been an off again and on again trading period here for the last couple of weeks. So again, as you can see here on the screen, we did rebalance the focus growth, the focus dividend, the sailboats, the real estate, the metals, almost a complete portfolio rebalance on all assets, and it was normal. What we got caught in the middle of this time is that, as we've been talking about, we've been shifting from growth to value. There's been inflation scares that are manifesting itself in the 10-year bond. We'll talk about that in a minute. And so that's put through some cold water on the growth stocks, some of the more tech stocks. And so we put some stocks in, and then the Friday after we bought them, they had negative earnings revisions. And so we ended up taking them back out on Monday. So we've been really busy and active. And again, we're going through a change in the market. Historically, I think we'll look back and this will be a reflection point, because inflation and interest rates are probably getting ready to rise after 10, 20, 30 years of being relatively low. So we are in some turbulent times. So what drives the markets? You've heard me say this many times because it's continually what we look at: inflation, interest rates, corporate earnings, and the Fed. And so we're going to talk about those today. And again, what we have our eye on right now is we're still watching the 10-year, we're watching inflation, we're watching oil, the VIX, and what the Fed is saying about what they're going to do. Okay, so let's start off with inflation. Why not? This is really what's roiling the markets right now, in particular your Apples and Amazons and the large cap tech stocks. And people are worried about inflation, and we would say, why not? We think maybe by the end of the year we could be at 2.5% inflation rate on an annualized basis. And why? We asked why. Why now? Well, we have so much fiscal stimulus that's been unleashed into the economy. We just had another $1.9 trillion package pass here, I think, this week. And so eventually that money will find its way into the economy. And like we've talked about in prior videos, all of that cash, that 3.4 or 3.5 to $4 trillion of cash, has to go somewhere. If people spend it, it will be highly inflationary. Will they invest it in bonds, cash, stocks? Historically and empirically speaking, that money will go to equity. So we would expect a positive effect over the next 3, 4, 5 years. But in those prior periods, that wasn't accompanied with high inflation. So we'll have to see what happens. People have more wealth now than they do before COVID with the stimulus checks. People have been saving. The market's been going up. And so, again, if people are feeling they have a buck or two in their pocket, they're going to feel more comfortable spending. GDP, we thought at the beginning of the year would be about 4 to 6%. This quarter alone, we're probably looking at 10%. And so as the spending recovery continues, with these more states opening and the COVID vaccines being disseminated, we would expect inflation to pick up. So if you look at this chart here, you can see the red line is the Fed targets for inflation at 2%. And remember, their new speak, what they're saying is they want to average 2.5 or average 2% inflation. And so in order to get an average of 2, you have to have something higher than 2, right? And so we believe we can be above 2 for this year. The white line is the University of Michigan's 5-year inflation outlook, and that's at 2.7. And then the orange line is where we currently are based on the PCE annual inflation rate, and that's 1.5. That rate has come up since the last time we did this video, when it was about 1.1. Okay. On the bottom of the chart, you're going to see a blue line. That's the unemployment rate. And as unemployment continues to come down and remains low, that means more people are back working, which is a good thing. But that means more dollars chasing fewer goods, and that can be inflationary. So our thought is inflation. Why not? And again, what that's doing to stocks is putting a downward pressure on valuation, because mathematically, as the discount rate comes up, as the cost of money comes up, that puts a downward pressure on the PE multiple. And so it contracts that PE multiple, which reduces valuation. So all of this is really a valuation proposition. And so that's why the growth stocks are being hit harder than the value stocks, because they've started with a higher PE ratio, so they have farther to fall. The delta, the rate of change from, let's say, 40 to 30 is a lot bigger than the rate of change from a PE of 15 to 14. Okay, so we're seeing some more leadership in the focused dividend portfolio. And again, that's why we recommend splitting those portfolio, having some in focused growth and some in focused dividends. So we're positioned well for that. Okay, now we're going to have to be patient because a lot of these good stocks, and the Amazons, the Microsofts, the Apples, these are very good companies, and we expect them to have high growth rates. So we're going to have some growing pains as the economy shifts to a more high inflationary period. Okay, so we're not going to abandon those companies. They have great management, they have good financials, they have a lot of cash, and they will survive. They have great growth rates. Okay, but they are being caught up in this high beta trade right now. And so they won't escape that, but we're not going to abandon those companies. Again, we got rid of the Melly and the Teldocs that are smaller tech that don't have the earnings. And when those earnings revisions get revised down, that is when we made a decision to take them out of the portfolio. Interest rates are positive. You see, we don't expect a recession. The 10-year is at 1.5% and has been high as 1.6. And so the Fed has said that they're going to let rates run, or they're going to let the economy run. It's starting to get going, and they're not going to try to pull it back right now. And so again, we'll have to watch what they do. But right now we have a positive shaped yield curve, and so that's okay. Again, if interest rates go from 1.5 to 2, we are going to see the markets pull back a little bit. And the reason these rates are going up again is because of the fear of inflation. And again, the reason the stocks are going down is because the higher rates, the higher inflation leads to higher cost of capital, which is that downward pressure on your PE multiple, which is a crude measure of valuation. Now here you can see the 10-year. The 10-year was at 60 bips not too long ago, and it's now at 1.5. And so historically, 1.5 is a low rate. That's not concerning, but it's how fast that we went from 0.5 to 1.5 that is concerning the market. And again, we probably will end the year at, I would guess, at 2%. Okay, so we do expect some more turbulence, more volatility as the markets adjust and this 10-year rate starts to stabilize. Okay, now this is the dot plot. The dot plot is what the Fed governors say they're going to vote for when it comes to setting interest rate policy. And as you can see, they're not expecting to raise the rates until 2023, in which case we'll see a pretty sharp rise up to 2.5%. Now, if the Fed lets the economy get too far ahead of itself, you may see them having to raise rates sooner than this to fight that inflation, okay, and to control the growth. So this we'll keep an eye on this, but this is the data that we have as of the most recent report. Okay, so we always keep you up to date on the dot plot. As far as earnings go, remember that's another thing that really drives earnings. We had inflation, interest rates, and earnings. Corporate earnings right now are about 122 looking over the last 12 months. They're projected to be about 165. So if you take the rate of change between 165 and 122, that gives you almost a 35% increase in earnings. And so that will be helping the market. So earnings are looking good. Inflation, we're starting to get worried about. Interest rates are low, but the rate of change is worrying us a little bit. Okay, so we're just in a state of flux. So what does that all equal to on the S&P 500? Well, currently the market is about, in the white line here, about 3039, and the consensus target is 4364. So again, that would show you a 10.8% expected return in the S&P 500 over the next 12 months. So again, we think that we can still have a positive year. We're just starting to see different leadership from the FANG stocks. We're starting to see broader participation from the dividend portfolio, from the value companies, from the dividend companies, the oil companies that were down. They've been leading the way this year. Apple, which led the year last year, is down this year. Financials have been leading the markets as well. So we're just seeing some leadership change. But again, the large tech growth companies in our portfolios are world class. We're just going to have to be patient with them. When it comes to the asset allocation side of the coin, right, we always talk about asset allocation versus focus investing, risk on versus risk off. So when it comes to the asset allocation, I ran 5,000 Monte Carlo simulations against our optimization construction process. And you can see here on the red chart that the expected return is about 5.5%, with 90% of the time the portfolio being between -8 and 20%. So again, about a 5.5% expected return from asset allocation, a 10% expected return from focus investing. On the right-hand side of the chart, you can see some numbers. It's pretty hard to see, but that middle column where it says black lit return, that is our new estimate of return. So on the S&P 500, 6.7%, emerging markets 8.44, small cap 8.25, corporate bonds 3.43, and you can read the list down from there. So again, we still have expected positive returns in equity, but we are seeing some shifts. We're okay with that. We just wanted to communicate that to you. Again, our actions over the last couple of weeks was a normal scheduled rebalance. It was not because it was not in reaction to the 10-year. It just happened to coincide perfectly that they were happening at the same time. We will rebalance the portfolios again in May. We did raise a little more cash in the focus growth, so we are sitting on some cash in that portfolio and others, and hopefully we'll get deploy that cash back into equities over sometime this year. So thank you so much for your trust in us. And if you have any questions, please give us a call. But we want to give you a quick update on why the markets are playing, risk on and risk off, and why they're changing their minds every day between inflation and no inflation. The NASDAQ going up, NASDAQ going down is a daily occurrence, and now you know why. It's really the rate of change in the 10-year bond, which leads to the expectation of inflation, which puts downward pressure on valuations of equity. Okay, guys, well, thank you so much. Have a great weekend. We really appreciate you. And if you need anything, just give us a call. Again, I'm Joe Masson. Thank you very much.